Hello and welcome to the Global View on this Tuesday. Well, US Treasury yields rose ahead of the Treasury Department's update on its financing needs for the current quarter. It said it expects to borrow $776 billion in the final quarter this year, the most the government has ever borrowed during a fourth quarter, but it's $76 billion less than the estimate Treasury made in August. In the previous quarter, the US Treasury forecast borrowing of $1 trillion. $274 billion more than initially expected, which sparked a sell-off in bonds on concerns about the rapidly growing US debt and widening budget deficit. Well, the yield on the 10-year note was up 5 basis points, just shy of 4.9%, and the Japanese yen, well, that's climbed to a 2-week peak against the US dollar, and reports that the Bank of Japan is considering tweaking its yield curve control policy. The Aussie dollar trading up at 63.7 US cents, and the euro is stronger against the greenback. This follows inflation data out of Germany, which showed price growth eased to its lowest level in more than 2 years. In October, down to 3%. A separate report showing Germany's economy shrank slightly in the third quarter as Europe's largest economy continues to be weighed down by high interest rates, GDP falling by 0.1% quarter on quarter. Let's catch up with what's being said out there at the moment. This tweet from Mohammed Al-Arian. Typically, the broader financial markets don't pay much attention to US Treasury's quarterly refunding announcement, which I just illustrated there. However, this is changing, as noted by Bloomberg. He says, due to the growing concerns surrounding who will purchase the larger volume of debt being issued and at what yield, as those concerns widen about the US budget deficit. Well, will central banks fail to exorcise the pandemic's lingering inflationary shock, just as they failed to exorcise the inflationary shock that came in the early 70s? That's a question posed by Dhaval Joshi from BCA Research, who is vigilant for signs that central banks are capitulating prematurely, meaning that inflation will not fall below 2% and that they're repeating the mistakes of the 1970s. Let's have a listen to what he has to say.
I think the main concern is, where is that victory line? And I think that the victory line is further away than the market thinks and a lot of investors think. So my basic point is that if we're targeting 2% inflation, and that's our definition of price stability, and we've been above 2% for some time, and sharply above 2%, then to get to that sort of average of 2% over the long run, you need to actually undershoot 2%. To achieve that sort of price stability target. I think a lot of people are missing that. So if inflation is running at, let's just say, sort of something close to 4% in the US, this is a really important point. A lot of people are saying, look, once we're sort of below 3, once we've got like a 2 handle on the number, we've kind of won the war. And I'm saying no, that's the wrong answer. You need to get to below 2% at the low point of the cycle to say that we've sort of won the victory against inflation. That's gonna require a lot more pain than is currently being anticipated by a lot of participants in the market.
So, are you expecting then perhaps that central banks are going to have to continue raising rates, or at the very least leave them where they are for an extended period?
Yeah, so I would say that there's a few questions we have to ask is, are we at peak interest rates? And the answer is pretty close, but we might, if sort of inflation proves to be a little bit more stubborn in the coming months, there might need to be a further 1 or 2 hikes, but we're pretty close. But then the next question is, how long do we stay at this very elevated level of interest rates? And all the indications are both, from the Fed, from the ECB, from the Bank of England, is that we're at this sort of elevated rate of interest rates until something breaks. And then when something breaks, we kind of get a discontinuity, a sort of phase shift in the economy. It doesn't things don't break slightly; they sort of tend to break in a big way. So that's the worry in a way. Is can a lot of the bullishness we've had since the summer has been on this presumption that we can kill inflation without killing the economy. But I'm thinking that's going to be that's going to be a very, very tall order.
Well, yeah, but you talk about perhaps something breaking, and that was certainly an issue. Many people looking at that potentially, given that sharp sell-off we've seen in bonds, those yields rising dramatically. Was that perhaps, is that yet to pan out, do you think?
Well, I think that the point about keeping rates elevated for some time is this sort of realization that it takes time for higher interest rates to hurt the economy. And the simple reason is that a lot of economic agents, whether it's households or firms, they're not borrowing at the short-term interest rate, the Fed funds rate or the ECB repo rate or the Bank of England base rate. You might be on a fixed rate mortgage, and only when you have to renew the mortgage, as an example, that's when you actually feel the pain of higher interest rates. And for a lot of, for some people that's not imminent, or that hasn't been imminent. So those high bond yields that you speak about do take time to hurt the economy, and that's really the big question that the central banks are asking. How long is it going to take? The other thing to bear in mind is that what really hurts the economy is the real interest rate. So it's the interest rate adjusted for expected inflation. And this is the key point, that the real interest rate has only become punitive very recently. So if you look at real interest rates, whether you're looking at the United States or Europe or the UK, you've only got to sort of above 1%, or sort of getting up above 1.5% in really the last 3 to 6 months. So on the basis that it's a real interest rate that has, that's what's going to hurt the economy, the period of tight policy has not been as long as a lot of people think. So yeah, that's the answer to your question, is that those high bond yields, so you're at a sort of punitive level, or the bond yield is, you could say monetary policy is tight, but has it been tight for long enough? That's the sort of open question that central banks, investors, and the market is trying to answer.
Darvel, many comparisons made with where we are now with what happened in the 1970s with the oil shock and subsequent stagflation. Is that a fair comparison?
It is a fair comparison in the sense that what happened in the 1970s. I mean, what's really interesting is that inflation expectations in the late 60s were actually quite well anchored, near 2%. And then what happened was that there was a big shock. Now, the shock, this is the interesting thing. A lot of people say the shock is the oil shock, but there's actually a shock that is sort of overarching, which was the collapse of the Bretton Woods monetary system, which happened in August 1971. So a lot of people forget that was the main shock of the early 1970s. The oil shock was a response to that. The reason that the OPEC pushed up prices is because the real value of oil, which is obviously priced in dollars, and remember the dollar was now collapsing against gold. The real value of oil was really dropping very sharply, and they used the excuse of the Yom Kippur War to raise prices, but they were just playing catch up. So the real shock of the 1970s was the collapse of fixed exchange rates, the gold standard. This was like the pseudo gold standard. So it's a very, very big economic shock, and that's really where the inflation came from. Now, where we are today is the big shock, of course, was the pandemic and all the dislocations that caused. So I think the sort of lesson we learned from the 1970s was that inflation did start to come down in the recessions. There were several recessions. Inflation came down, but then central banks capitulated too early. They didn't let inflation come down far enough to re-anchor expectations. And that's really the thing we have to look out for now, is that are central banks going to capitulate when inflation gets to around 3% or 2.5%, because I think that wouldn't be good enough. And that was really the big mistake of the 1970s.
Darvel, of course, the parallels are hard to ignore with what's happened in the 70s with the Yom Kippur War and what is going on now in the Middle East with Israel's war against Hamas and the impact this is having oil potentially is if it expands. What concerns are there, perhaps the inflationary effects that a sharp rise in the oil price would have more globally?
Oh yeah, I mean that would the put it this way, that at the moment global growth is pretty weak anyway. So the best estimates would suggest global growth has slowed to around 2%, mostly because of a big slowdown in China. Also, Europe is sort of close to sort of zero growth, and the US is sort of doing quite well, but it's the only major economy that's doing well. So we're in a weak demand backdrop anyway. So if the oil price went up, $20 or whatever, there was some sort of geopolitical shock or escalation, that would certainly, very likely tip the global economy over the edge in terms, we're on the sort of cusp of a recession. We're not there, but that could be, that sort of the final nail in the coffin. Because we are we're already starting off in a very sort of weak demand backdrop at a global level. So I would say that if we had a spike in the oil price, and that of course could happen through some sort of unpredictable escalation of the war. My point is that spike will not be sustained because it will cause massive demand destruction because demand is already weak. But the other point I would make about the war, just very quickly, is that to get that sort of spike in the oil price, you need to get Hezbollah or Iran involved. But all the indications I'm seeing is that it's really not in their interest to escalate. They don't really want this to escalate. This is not like a sort of World War I scenario where the dominoes quickly topple. That's not my understanding of the situation at the moment.
We're almost out of time, Darvel, but just in terms of portfolio construction then, to see the recommendation there essentially remaining long bonds and short commodities.
Yeah, so I just think that again, look, with the short commodity view, of course, that's at risk from some sort of unpredictable escalation. Of course, you will see that will cause oil prices to spike. But as I say, that will not be sustained. So if you can see through that, if you're saying how should I be positioned on a 3 to 6 month view, I think that will still bear fruit if you're underweight commodities. Because remember also that outside oil, let's think about metals. China is, of course, the biggest consumer of industrial metals. 60% of copper consumption is Chinese, and it's very difficult to see the Chinese economy accelerating dramatically from where it is. Of course, I think that the authorities will want to stabilize growth, but we're not going to be seeing high single-digit or double-digit growth as we have in the past decade or so. So we're in a sort of much, as I say, slower global growth backdrop.
Dhaval Joshi from BCA Research. That is the Global View. Stay with us. The Open is next.